So the idea with this AMA is basically to promote that we're gonna start a guarded launch of our first vault tomorrow, and GLP AVAX++. I'm gonna be in the details a bit later, but I want to basically give an overview how we come up with the initial vault and more or less the framework we use to create vaults. So I get a good feedback about this article in particular. When I basically explain, because I'm in trading in basically I'm 18 and I'm big 30 now. I give a lot of stuff for granted, but for most of the audience are not. So the idea is, first of all, you need to understand what's the difference between the sell side and the buy side. They normally in TradFi are completely different entity, but in DeFi are kind of the same. Is completely changed the barrier. So the sell side, if you just think the simple way to think about it, simply about an IPO, is people that price your deal and they try to marketing. So they're trying to sell you something, and they are typically they don't really believe in any fundamental view. The only things they want to do is get a commission. So in DeFi, it's called LP. But the idea is just they provide the liquidity, the upside and downside, whatever is more in the downside typically. So in a pool, you can model it in option as a look side straddles, where you lose a lot when you go to zero and less when the market go up. Impermanent loss is a terrible term because it's nothing permanent. It's a rare mark to market. If you want to get out, you realize the loss. But the idea is on the other side, in the traditional finance, there is the buy side. Buy side are hedge fund, pension scheme, and more recently are prop trading firm. They tend to do also market making, but they don't have the same regulatory. They don't have to market make. They can decide if you want to provide liquidity or not. And the idea, each buy side have a different way that to make money. So there is different sub strategy. And I wanted to give you an overview because we strongly believe that there is no the perfect magic formula, the perfect strategy going to work. So as both BWS and D squared, we're going to combine multiple of these strategy to provide superior return. In sense, if you don't diversify, not just by asset, because everybody understands to diversify between 20, 30 stock, but very few people diversify according to a strategy. And that is what actually a lot of added value that we add is not just to find the perfect handle, the perfect text fit. And the risk management is very important, but still not the one that makes you money that much. What is actually help you a lot is diversify between different strategies that works in different environments. So the first strategy, the simple one, actually the simple mathematically is high frequency trading, which is simple mathematically, but it's very hard to do in terms of infrastructure. So the mathematics behind the high frequency system is not that hard. So in 2014, I was in Thailand, was running high frequency strategy, working fine. But the problem is actually you get the signal on, and you never get the feed you want. So I have a strategy that basically never lost money, but make me very little money in absolute return. So at some point it's very hard, and the skills that you need are actually different. So to be a good HST trader, you need to be a C++ rock star. You need to be very good to optimize or memory management, or you can even go to assembly or FPGA. So I have a master in IT, but I'm not I start as my bachelor is in economics and did the first master in investment management. So I just studied IT because I see the future was there, but I'm not the most brilliant coder in the world. And there you really compete about raw trading, low developer skills, not much understanding how the market works. You need both, but it's more about very, very good coder and optimize coding. So at the moment, we will not have within the voltage frequency strategy, but the idea is I find a very smart kids that I can teach in the risk management and the finance part. There is a brilliant coder and can use the signal I generate and incorporate, we're going to incorporate also HFT strategy, but it will not be a stock. Arbitrage strategy is the easiest thing to understand. So you take some assets, they are the same or very similar in different exchange, in different venue, and you take a spread. So for example, now is the trade is already like kind of how to say close. But for example, I took a short in Apple Exchange for just a bucks. In Apple Exchange, certain price, whatever, and you take the longs in GMX at the discount, because Apple have a liquidity problem, so it's not the same liquidity on GMX. So GMX is based on Oracle, blah blah. But the simple concept that is the same things, the trading at different value for mainly microstructure reasons. So there is people don't want to trade in a venue, for example. So I know quite well you take counterparty risk, but I know quite well the Apple team. I'm actually a committee, so I'm not really worried about the counterparty risk there. There is some smart contract risk, but the idea is very simple. You can choose similar things, you sell one, buy another, if there is enough spread to pay the transaction cost. And we're gonna have a mix arbitrage strategy on it on this square in the Apex Vault. That will be the last one that you want. The problem of arbitrage strategy, by definition, doesn't happen all the time. So you can't just run a vault and say, do arbitrage. Because arbitrage currently increase when there is high volatility, like yesterday, but most of the day there is really nothing to do. So you can't really release a vault for poor arbitrage strategy, because most of the time it's just nothing happened. So another strategy is called momentum or trend following. So if you go pure academically, it's different, but let's say are more or less the same. So the idea of stuff going up, you buy, and the idea is academically the fundamental reason for the trend following is the news are incorporated slowly than the market. In practice, seems to be a mostly behavioral issue, so there is never one factor that define a statistical relationship. There are multiple. That is what makes it hard. But the idea is people see stuff go up, they get interested, they build a narrative, and stuff going up because people feel FOMO and go up until they reach a climax, where basically the expectations are much higher than the market itself. So let me show you a good example that is more simple than crypto to show. So Carvana, that is basically a used car in US. So you see that was 18 in COVID, because of course people couldn't go outside. But yeah, crazy run for what is it? It was $7 to $350. Shitcoin hyper volatility, simply because there was it was very short squeeze initially. So a lot happened within GME, happened in a lot of this stock that theoretically did very bad in 2020 because they were did bad in 2020, so people were short, but there is no liquidity and people was forced to buy back. So this stock went to the moon. And the idea is when the stock go up that much, people invent a narrative to justify the price. And people were effectively in US pay a lot to buy used car. But if you see at the top here in 2021, the expectation that the used car were more than the new car because simply new car are not available. All this bullshit. So the price at some point, if you see usually have a climax and it completely there is an unwind on the trade when it's going. So this is very clean momentum behavior you can trade. And the idea of momentum trend follow it tend to be a bit longer dated or very, very short dated. So it's not, as you see, the next one is mean reversion. This is basically the reverse. You get stuff to go to outside the mean relationship, more the median, but it's called mean. And you sell the expensive, you buy the cheap because they tend to come back. Like the classic example is like Visa, MasterCard, this kind of stuff. But the point is momentum and mean reversion are not, even if the implementation is completely opposite, is actually I'm not, if there is momentum in the market, it's not that cannot be also mean reversion. What is really important is understanding which time frame you can have a mean reversion. So for example, in Carvana, you have mean reversion according to a trend that doesn't happen to be straight, but mathematically who cares? You still have this kind of effect that is a mirror. You can trade some mean reversion strategy on top of this, but in a very short term, you can have a longer term riding the trend in the upside and downside. We don't care in a momentum fashion. So the idea is you want to combine both momentum signal, both mean reversion signal, and have some mathematical parameter to adapt in which different market regime you are. It makes sense? After that, there is also a low frequency strategy. So you have a view, you think it is the best, is the future final. Study fine strategy. What is really important though is decisive. So if you have very fundamental view, means your stop loss need to be very wide, because you basically imply you don't have any market microstructure hedge if you have that kind of bet. So you need to be able to absorb a lot of volatility. So even if you're right in the hand, but you have a strong view and the market go down 20% against you, you get scared, is not you will not be successful trading. Another things you can another type of trading that is very related is tactical asset allocation. So how you balance, how you basically play the correlation between different assets. So in crypto, everybody is a kind of a function of it. And the alta function, Bitcoin is a bit himself, it, and all the alta are function of it. So the diversification benefit is not that high, but historically, at least, I don't know, the classic 60-40 portfolio is 60% equity and 40% bond, because there is a diversification benefit. And you can do that in also not just by asset, but also by strategy. This is, you can think as a vault, a different strategy, and we put together. In this squared, you were able to select the dishes as you want. In BWS, you will have just one portfolio optimized and built by us. Other couple of trading, there is a special trades, for example, sentiment, Twitter sentiment. I actually never made money in Twitter sentiment, but of course in TradFi. But in crypto, of course, you can do short-term strategy that seems to work because simply people just react on CZ in the last couple of days or SBF or whatever. And the last one that is actually all the real edge of BWS Labs engine is volatility trading. Volatility trading is much more flexible. It doesn't advantage versus linear trading. You just trading different relationships. So as I mentioned before, having a distribution, if you just trading linear trading, you can't really fit if there is a probability that stock move 20% or 30%. You can't really trade in a delta one, so the future trading, but you can fit some specific parameter distribution using option. So options, people are using to make a punt on direction. That is a very bad use for option if you want to make money consistently. Option, how I trade now, we're going to be in the vault, in the Apex particularly. You basically find where there is mismatch between supply and demand of option, and when there is, because end user of derivatives tend to move in order. They just follow the last shiny thing. So people at option traders stuff a lot of times are not very sophisticated. Just people are punting some particular relationship. So not just a long was a 21 thing, but because 2017 and 18 people were net short option a lot to XIV. I don't go in details. I write a paper on the PhD if you wanna. I can share it later. But the idea, you can, there is a lot of more, from our board perspective, there is a lot of more misallocation of capital we can take advantage of trading the other strategy. Anyway, the main point of this is there is no magic formula. If you basically don't diversify through multiple strategy, you throw money away. Because even if you can ride a little bit of strategy seems to work, at some point will stop working unconditionally. And the idea is you want to have allocation to multiple strategy, and DSQ Vault you were able to have GLP++, which is a smart beta strategy, the one I'm going to release tomorrow. And that strategy is basically taking advantage of a GLP yield on top of the fact you can synthesize some exposure on top. So for example, is a different parameter. You may or may not want to hedge the exposure of BTC, AVAX, or W8. They are in the vault according to a different algorithm set. So a lot of people, you see people just say, come up with the market neutral vault. It's a fucking bullshit marketing buzzword term. There is nothing market neutral. You always take some kind of risk. Market neutral means you neutralize technically the market go up or down. But if you neutralize exactly as Umami vaults show, you don't make any money, you actually lose money because transaction cost will lift all your edge. So at BWS trading engine will actually take other signal and will not simply delta hedge the exposure precisely. It's all according to a signal that in this case in GLP++ is a momentum trend following signal. So the idea you have a more upside in upside, but in downside you don't lose that much. What you lose more in the choppy market. And the idea the other strategy like the GAPEX will take advantage of the short-term reversal, and if you allocate to both, you will do much better than trader by himself. Yeah, so the other things I want to show you, next second. What is it? Okay. So when you trade option, so to come back a little bit before, this will be more relevant. So Bloomberg doesn't have option data for cryptocurrency, but a constant the same. You don't really care which option you trade. So, for example, these are live position that we have. So when the KWeb blew up a couple of weeks ago, I was liquidity provider. And I make money in the delta. I hedge the vol around. So at the moment, I'm short KWeb vol at 70, 80 vol. And I'm long HSI vol at 35, 36 vol. So I'm taking a spread on each basis. That's important. What I want to show you is basically what you actually care. You just care about the Greeks in your profile. So for example, at the moment, I'm net short 30K USD of delta between different. So short HSI, long KWeb, and I'm net long gamma. So typically the portfolio of the Apex is going to be net long gamma. What does it mean? Market go up here more longer, market go down or less long or more short. And that is not, and you need to understand exactly what your gamma profile is. It is not a linear. That is what makes option trading complicated. And the Vega, you can have a calendar spread. So Vega is the sensitive volatility. So gamma is, you can think about it a bit what happened. So a big move is good to be long gamma. Vega is a lot of Walmart expectation because it depends how much people want to pay or not for the vol in the future. That is based, of course, in what happened in real life, but is happen a lot to be more influenced by positioning. So there is people that do overwriting strategy. Vega tend to be cheaper, and it's not just related to what happened. It's already about what people do recently. Instead, gamma is more what happened in the spot, and there is a reflexive relationship with option and spot. In TradeFi, because it's bigger. In crypto will be probably his, but now the volume are so low in crypto options, so it's not super relevant. It's a bit relevant for Ribbon DOV. So on Friday, there is some relationships are tradable given the expiry. But the core idea is the Apex will not very important if you're along the 1600 call or the 1500 call. Who cares? The important is the Greeks. They give you exposure to that, and you can hedge with the future according to what strategy you want. They can be delta, target a delta national of 0, but it will be market neutral, risk neutral, all this buzzword. But you can also have a target in other delta levels according to the market regime, according to the model, basically. Okay. Let me come back. Are you guys still there? I speak a lot, so I completely forgot to.
Yep, still here.
Yeah.
Yeah, we're still here, man.
Yeah, I think we opened the Q&A question. Just let me figure out. I'll come back to the main screen. Where is it? Okay, stop share. Okay, I can see you again. So yeah, so okay, there is a Q&A. Yeah, I didn't open once. Okay, I can see a question on DeFi Dope, which is theme. So you can ask me every day. But what's your thought on the effect of FTX blocks in DeFi? So I think in DeFi in the short term we'll kill competitive volume. So kill volume means a very erratic market. In a sense, there is short-term behavior that are tradable, but not much something you can do continuously. So it's more a trading environment, you call it in general. But I think long-term is good because actually SBF was kind of tried to kill DeFi with regulation. So we need to see exactly the one position area will be that people are going to focus on checks regulation, because all the people that blow up are actually coming from there, and will be less harsh against the DeFi. Okay, so let me take the other question that was in the chat before. So, question from Vate. It's a more info in tokenomics, broken down vesting schedule. Vate, you there?
Yeah, here I am, man. Yeah, I was collecting some questions from the community, from mythical community. You know, we are interested in participating in the private round for like DSQ. So just a couple of questions came out, and I thought that I would ask them here, as most people are asleep probably now.
Sure. So let me take you to the relevant relevant medium piece. Just 1 second. At least I'm sure I talked about it. Okay, sure. And then can you see my tokenomics medium piece?
Yep, can see that.
Yeah.
Yes, sure.
So basically, if you read all, the idea is our protocol will generate commission and a fee that's gonna 50% will gonna distribute to user, but that is a function of TVL and performance. That by itself are also reflexive kinds of good performance will increase the TVL and will increase the fee, but is very hard to predict when. So the idea is the protocol will accrue value in the future, but we need time to basically build, and that's all the point of add a vesting schedule. So to a token. So the public sales, of course, these need to be unlocked token, and so we'll say an higher valuation. And of course, will be market dependent, but at the moment the prospective valuation total 4.5 million on a public FDV. And instead, for the private sale for the seed, we do 15 million, but we are longer vesting schedule. The idea for the vesting is in 6 months. For the private sales, all the team is locked in the same constraint of the private sales. So the private sales investor and team are exactly the same. So the incentive are completely aligned. And in 6 months, everybody's completely locked. And after 6 months, up to 20% of the team plus private sale allocation will be available in DSQ bond sales. So you basically, you have a soft unlocked after 6 months, if it makes sense. And that is according to the market conditions. Say the both are very profitable, is probably a token do very well, and it's easy to rise 200, 300K per month, and you can get the money back in sense early. Of course, if you want, you can keep it, but you're gonna receive the right of allocation to basically cash out, but not in a way you're not, it's not a prisoner dilemma. So in a lot of projects, you see, okay, this vesting, everybody unlock. I don't know if you follow Mami. You see, when there is a lock, token go down like crazy. We don't want that. What we want is basically allow the protocol to build. And after from 6 months to 12 months, there will be DSQ bonds. After 1 year, we're basically more linear unlock, parameterized according to the value of the protocol. So if there is liquidity in the market, this will be one parameter. And if there is price is X amount of a public sale price, there's another parameter that facilitate a faster unlock, if it makes sense. And here is explain basically everything. The idea is, so the example we put here and say, imagine if you was taking 1,000 DSQ, this is for the staking, but the concept is similar. The idea you have, you're gonna receive and you wanna sell DSQ when we have proven it will generate fee, and so there is a matching between cash flow and the value of the protocol. Because end of the day, in 2021, we were policy all this shitty stuff, but we believe that a protocol has value just if you create ultimately create some cash flow in terms of fee for the protocol. Let me know if I answered your question or if there is other.
Yeah, no, thanks, man. That's good for me. I'm gonna point them to like, you know, that Medium article. I think that like most of the confusion came from the fact that like people expect like, you know, to know like immediately like how many days my tokens are going to be invested and if an unlock is linear or not. But
yeah, so the idea, the language I use in Tokenomics give us some flexibility, because you basically, if you put a linear exact investing, sounds very easy, but it's not, it for sure is not optimal way to do it, because it really depends on the market. So say the Fed start to easing again 1 year from now, when there is a unlock, which is not certain, but definitely possible. You probably have a lot of liquidity. The point is you don't want to have more liquidity in the market can absorb without completely killing the price. So is the things I always say to all the private investors and say, you have the same align of the team. So we will try to optimize given the reasonable variable at the time, and but we don't know the future. Otherwise, we'll not really manage the pure money. We just retire on a beach and just trading ourselves.
Yes, that's yeah, no, like I totally
and
get it.
The other question, yeah, the Dopex, the idea of so private sales 15 million, public sales 34.5. That according, it's very difficult to look historically because most of protocol are Ponzi, so you can't compare it to a Ponzi if you want to be a protocol. But the idea is sounds more or less what is decent to basically between the private sales and public sales should be indifferent in sense of term of value because you basically you're locked, so you're investing, that you need to have a discount. But the idea is should be more or less fair if you allocate in the private sales or the public sales. On average, if you play the game 100 times, more or less you should do about the same. The only thing is private sales is advantages is a kind of lock, so you can already prepare the stuff. If you do a public sales, if market goes down 5%, you get scared, you take off, maybe you lose all the upside. So actually behaviorally, vesting is not a bad. If you believe in the protocol. If you don't believe in the protocol, you should invest anyway. And yeah, so for DopexNFT, our 50% joint venture, we added this basically 100% bonus if you hold for 10 weeks, because we aligned the incentive to basically have the forced demand when there is no much demand because the cash flow, the fee are not there yet. And yeah, so that is definitely the advantages if you have. But again, you tell me what is better. In my mind, or I model it, it should be basically the average scenario should be basically the same for the three options. We try to be fair, of course. There are some assumptions to that, but it really depends to you. So DopexNFT NFT also will have some discounted fee in the future. All the details depends. The bank diagram, the people are going to be in the private sales, so the investor and the token holders. In a lot of projects are maybe different, but we need to see in our project. The idea if you're early, we're gonna take care of you. in try to appreciate that you've been one of the OG of the protocol, if it makes sense.
Yeah, no, totally. I might have just missed like a couple of details, so I'm gonna ask them again. Like, so basically, I mean, there is like the main difference between like the private sale and the public sale is exactly just like if you had to summarize this like in one sentence so that I could report it.
Valuation, you get 50 million or 34.5 million, which is 2.5x ish. Okay, so you get 65% discount if you buy on private sales. The difference, the trade-off, and the vesting schedule, but you are the same vesting schedule of the team, which you can assume in the long term is advantageous to be completely aligned with the team.
Yeah,
because we gonna, of course, we have more information about the predictability, when the vault inflow going to be increased or not. So it's a function, because we're an hedge fund, so the fee are generated according to the fee that is based on TDL and based on performance. Okay, and we will use the information to basically more advantage to our incentive that are same as yours. So I think it's safer to say that it's much better than you probably on the if you are a long-term investor, the private sales is much better for you. If you just a flip, of course, public sales makes sense, but I don't know what's the point to invest for a flip in a product like us, because we're not spending marketing. So flipping strategy makes sense for a Ponzi scheme kind of project, when they know that all the product is basically tokenomics, to print a lot of tokens and bring a lot, for lack of better word, the most stupid things here, just to be early and front run most stupid retail. That is what makes sense a flip strategy. We'll not use that, so we're not going to incentivize a farm. We'll not see 1000% in our farms. So I can assure you will not be the optimal strategy to flipping, but we understand if people maybe want to just try and maybe it's not a product for them. I don't know. You don't want to lock, of course, the private sales people. Let me know if it makes sense.
Yeah, of course, like, you know, it makes sense. So basically, I mean, private sale, you get like nice discount, you are more aligned with the team. And yes, of course, I mean, you are locked, but as you just said, like if you're here for like the long term, like medium long term, then like being completely aligned with the team can also be an advantage in that.
Yes.
And psychologically as well, it's kind of like, you know, if you buy spot like on public, then price goes down like, you know, 20%, you get scared and you just like, you know.
Yeah, but also because the protocol, one thing with betting is our capacity to manage money. So you really bet for the team in this side. So if the team gonna do very bad in terms of unlocked economics, you probably should invest anyway. So
yeah.
I invest in the Ponzi, the Wonderlands kind of stuff. That's of course I don't want to be unlocked clear Ponzi scheme. I want to be locked because I just try to punt a very short-term momentum. The idea that they use the token as a marketing tool, and as you see, like of course, in a project like that, you don't want to be locked.
Sure,
but it doesn't really make sense because if you invest in DSQ, at least how I think about it, is you basically want the future cash flow default. So if you invest in Rentec in the 80s, the hedge funds picked back $50 billion. We don't compare to that. We are less, we are happy with less, but you want kind of scenario that the investing strategies do well. And this, if it's not, it's probably not a project for you, I would say. If you just want to flip, and to, is not, it's not built for that. So.
Yeah, sure. Last kind of question, it's more about what you already said about with Dopex NFTs. So basically you get 100% bonus if you hold it for 10 weeks on the public round or on the private sale?
Or the public round. So basically
public
you
round.
Give an incentive to people to say the public sale is probably going to be 1 hit. So it's going to be small, 69 hit. So the idea, if you're the first supporter and you don't have so in this market especially, we can expect people to have 10 hit just to play around as a normal user in DopexNFT. So it's not the median outcome. So we're gonna be the benefit, but if you buy again all for 10 weeks, you're basically 100% simply because it's easy. But you basically 500% APY and 69 hit. So say all 69 people allocate 1 hit in the public sales. The amount we give you in bonus is just other 69 hit worth of DSQ. So it's not gonna be super diluted for all the other.
Yeah, totally. And this holding for 10 weeks, it refers to your tokens, correct? There is no different if you buy a Dopex NFT or the day before this happens or weeks before.
So they asked me if there is, it's okay, it's not. If you own the Dopex NFT and everything, this is more because they build the protocol, is how to say, ideally we don't want one guy take 69 NFT and do all basically the complete gaming of the stuff, but we can't really police everything. So we are a small community in sense, so we don't.
Yeah, you just hope that doesn't happen. Yeah, I get it.
Yeah, if it happens, we can take condition and I think most, because even is small. The point is we do a small public sales. Even it's not optimal, 69.8, who cares, honestly?
Yeah, indeed.
We just put some liquidity on his work on the farm, and but again, if you read the document, there is going to be liquidity weeks, so we basically don't want to try to match the token anyway. So it's the downside, of course. There is some downside in the approach we chose. We are completely aware of that, but I think it's acceptable considering all the other variables.
Yeah, no, totally. So you just need to participate in the public sale with a Dopex NFT in your wallet. You hold for 10 weeks, and then you're gonna just basically get double the original allocation. That sounds like a pretty good deal.
Yeah. Again, the downside is not crazy for us.
No, it's not.
Generally speaking, it should be able to widen in the reach and get the people from DopexNFT already to come to us. Kind of already happened. So,
yeah, no, it's good, man. Thanks for all your answers, man.
No problem. And nice of Evan. When it comes to public round, does the DopexNFT NFT matter? Yes. If I have 8, more DSQ. If you try to game the system, you have 8 wallet with 8 NFT accounts. I don't know if you can police that, but because it's going to be very small, say we're lucky going to be sold out very quick, the public says. So, or you build a bot to allocate, do programmatically, or you have time to get allocation anyway. So, I don't think it's a big issue. Maybe you have 2 wallet, it's totally fine, and you get this 100% bonus. They don't care about that, but I don't think the things is one guy gets 69 is possible in terms of timing. Apart is a super bot. I don't know why a super bot will spend time for 69. Okay, it's a public stage. Anyway, so there is other question, George?
Yeah, multiple questions, but I will try to keep it simple. So this is more related to beginners and people who are looking to learn more about protecting capital without having a lot of knowledge. What simple strategies would you suggest to new investors that are looking to protect their capital, especially in these very hard market conditions? Not in terms of token picking, but in terms of what they should do. Is it just DCA or something else?
So this is a good plug for BWS. So BWS, we're gonna offer the vault with gold vault. We initially just 1 volt, BWS or weather. One of the main difference in DSQ and BWS have insurance. So in BWS, we're not able to lose more than 10%. So probably that is a good location, a bit biased, but yeah. And but the idea is DCA did very well historically on the US market because it was a bull market, but went up. Now we maybe get a market going well for quite a bit of time. So I don't think DCA is a solution for optimal solution. The optimal solution, you have some kind of edge in trading because it's going to be a trading heavy market when the liquidity evaporates. And allocate to some DSQ vault and have always sample amount of stable or cash, whatever, to say take advantage of when market is something crazy. But this is not financial advice, disclaimer for people. But I will not think you can just allocate and not look in the portfolio for 1 year and do well in this market. If you really have a 10 years horizon, maybe it's fine allocating it. But in 1 year, you probably will need to trade a bit around.
Okay. To be honest, nothing feels really safe right now. Even if you had your cash sitting on a exchange like FTX, you would have lost everything. And on top of that, I can see that right now, USDT is depegging. So even if you don't have your cash on FTX, but on another platform and you have it on USDT, maybe you are losing. So yeah,
we're talking earlier in the Dopex chat about possible depegging.
Yeah, I guess there is no safe haven right now. So yeah, okay, makes sense what you said. Can't wait to see the BWS vaults. And
let me add Aaron, Antoine, if there are any questions, you guys. So Aaron, I actually never speak to Aaron. Aaron is a BWS team, but I don't think I saw I spoke his voice before. Maybe he's sleeping. He's in Malaysia, so I don't know. Aaron?
Hello, Luca.
Hey, how are you?
Yeah, just finishing my dinner.
Okay.
Watching you talk.
Do you have any question for me? It can be helpful in the discussion.
I don't really have any questions.
Good, very good.
Okay.
And Antoine, I don't know if I can pronounce correct your name. Apologies for that. If you have any question, please feel free.
Yeah, basically, I had a question about the Greeks, about you talked before at the beginning of the session.
Sure.
I was wondering which one do you look at the most? Because there is Alpha, Vega, etc. And
it is not, they work together. So there is a relationship. So for example, Volga and Vanna are the relationship between the Greeks. So there is delta is the first derivative. I don't know if you're from, what's your background in mathematics, but if you think it's a slope, slope. So y equal x equal y, the normal line equation. So delta is the slope, and gamma is the acceleration, if you like.
okay.
And the idea of gamma is basically allow you to basically take advantage of realize event, then move more than what is expected in the market. So a lot of money that historically is related to the gamma side of the business, but Vega, there is a relation between Vega and gamma. So Vega and gamma, they always come together. If you're long, you're both long gamma, long Vega, long option, at least in vanilla. And in exotic, you don't have the relationship change. But to answer your question, there is no one Greeks you just look at. Is Vega. One thing is change is Vega tend to be more stable. So if you're long 100K Vega or something, 100K Vega means if the vol go up 1 point from 20 to 21, you make $100,000. Okay. In gamma notional, that is typically what you're looking at. If you have $1 million gamma notional, is if you are delta flat at T0, market move, you have market move 1%. You're long 1 million gamma, you're more long $1 million. If it makes sense.
Yeah.
So
Okay,
it's different the way the thing is very different, and gamma you can basically just trade the spot because you can offset. So the point of Black and Scholes, they got the Nobel Prize, they found an hedging replication strategy or option. That is what it is. So if the point of Black and Scholes, you hedge until expiry, and you can, and if the volatility is priced equally, you flat even without transaction cost. If you want to trade Vega, you need to trade option against some options because it's all about expectation.
Okay, thanks.
No problem. Thank you for the question. Actually, I much prefer to just talk about option. Nobody will follow. It's fine. Okay, guys, there is the inflation number in 1 hour and something, and let's see what's going on there. Thank you for joining. And I know some people lose a lot of money last couple of days, but we're fine. So it doesn't really affect that much for us. Actually, it probably can create a lot of opportunity, especially since for us to trade around the next few months. So until we are small, it will be a bad environment. You have like $50 million under management. It will be a hard environment, but we don't have that problem yet. So we're probably going to be a decent environment for us to trade and make good return for the initial investor in the vaults. Thank you, guys.
Okay. Thank you, Luca. Thank you, everyone.
Thank you.
Yo, thank you, man.